I am very sorry. I made a big blunder when I lectured chapter 9, actually only the first hour. The other hours are okay, but in the first hour I forgot to switch on my mic, so it was not recorded, only the picture, but the picture isn't helpful. So I'm recording this directly from my desk to have a complete set of lectures. Thank you for your understanding. In the last lecture, we spoke about financial events and liquidity. Financial events is reading the financial contract along the timeline, its conditions, its legal obligations, and how they depend on the risk factor, and just calculate one after the other. From this, we derived last time already liquidity. Basically, we spoke about this part. Today, we will focus on value and income. We take the two together because they are closely related, as you will see, so it doesn't make sense to treat them separate. But you also see there is like a big chasm here. So there are like two types of interpretation of financial data in the financial world. So well, we have the liquidity world here, and here you could call it the value income sensitivity world. So the whole thing which you have on this side. Before starting, let's discuss the concept of value. Of course, the word value is used in many different ways, but here we mean value like valuation. The first question is, what do we understand if you say book value? What do you mean by that? And the simple answer is, book value is whatever we write into the box. So the number we have put into the box, that is book value. So you could think you can put any number. This is not really the case, at least not in banking. If you have a big investment somewhere in machinery, which you don't know whether you can use it still or not, then of course you can basically put any number because judgments can be very different. For a financial contract, this is not really the case, but still there's a lot of possibilities how to judge it. So whatever choose how to judge it, and the number you calculate and you put into the box, that is book value. So then, what is the difference between market value and book value? Now, if you choose market value to be your concept, then market value is book value. But often, if people talk about market value versus book value, then they mean that the book value is normally not the market value. It could be amortized cost or nominal value or whatever. We will see the different types of values. And then they think that parallel to this, we should also know the market value, which often is then a fair value. So in this sense, there's a difference. But in another sense, when you choose market value as your valuation principles, then market value is equal book value. Now, these differences of having book value normally not market value creates quite a few tensions, especially between bookkeepers and rocket scientists. We have been discussing that already. There is a lot of sneering from rocket scientists or from, let's say, the more mathematical minded people in banks against the bookkeepers, which I do not think it's justified. Even if maybe the rocket scientists are more intelligent than the bookkeeper, but the bookkeeper has a lot of common sense and he knows a lot of things intuitively, even if he cannot maybe express it too well. And if they express themselves, often it's very clumsy. So, but we can learn from them. So we should not take part of that tension. Let's be proud if you're a good rocket scientist, but let's listen to the bookkeeper as well. Similar tensions we have in the insurance sectors. There is between actuaries and asset managers. So the asset managers are on the side of the rocket scientist, and the actuaries are more on the bookkeeping side. A similar reason why the tensions are there. Now, we spoke already about the difference between market and book value. And market value really has a kind of special role in the whole thing. It's a kind of, let's say, the fairest of all values in most cases. And often this value cannot be directly observed. So we have the concept of fair value. Fair value is an approximation. Taking similar cases, you generate the cash flows, discount them, and the value you get, you say it's fair value. It says it would be book value, it would be market value if it would be observed. Okay, that is the meaning of fair value. Now NPV, the difference between fair value and NPV. NPV includes also accruals. That's often the case. Also in observed values in the market, they are without accruals, and NPV is the full discounted value of all future cash flows. Then what we need really is a system of parallel valuation. So we need a system where we can show classical book values, but also net present values. Actually, we need a system where we can show any value you choose. So if you, and that's also how risk score is constructed. So if you tell risk score, give me a value, then the next question of risk score will be, what do you mean by value? So you have to decide which value principles you want to look at, and given the value principle, valuation principle, it will return the value. So that is what we really need. But this is a big thing in most banks. This is very difficult to attain, often not attainable even, or if attainable, only with big difficulties. Now, this gives us an overview over all possible bookkeeping rules. We spoke already about book value and market value. So, but book value actually means any valuation principle, what you can choose. So let's see how many valuation principles are there in the banking world. First of all, there are two different sets of valuation rules. The first one is time dependent. So here, in this case, value is a function of the contract, of course, let's say the contract conditions, and T, and fully independent of anything else. In the market dependent, value is a function of also, of course, the contract conditions, but also of the market conditions, and also of T. That always plays a role. That's the different thing. So time-dependent bookkeeping rules only react on the conditions of the contract and time. Market don't play a role, where in market-dependent they do play a role. Now, let's have a look at the time-dependent bookkeeping methods. They are also often called accrual methods and so on. So first of all, we have nominal value, which, as we will see, is corresponding to write-off at the beginning. So nominal value, if you buy a bond for 100, if you buy a bond which has nominal value of 100, but you bought it for, say, 97, then the nominal value would be 100. That is meant by that. Historic value or write-off at end, that's just the other thing. If you bought a bond at 97, nominal value 100, so you would book it at 97 at the beginning and write it off at the end. Then linear to maturity, so you take the three difference, the 100 and 97 difference, the three, and write these three off linearly over time until maturity or until repricing. And then amortized cost, that is a non-linear, it's a kind of exponential function. We will see in more detail how that works. So these are the four principal time-dependent accrual methods. the market-dependent bookkeeping methods, the most famous of it is mark-to-market, of course. So here, everybody knows it. And there we have the two possibilities of fair value and observed value. So fair value is where you do not have really observed market data, which is in the case for most of the positions which are on balance sheet because they are not traded. Observed values are the traded instruments like government bonds or stocks, actually most of the stocks. So these are observed values, and so you just look what Reuters says on the screen, that is the value. No calculation there. Then there is a low of cost or market, which means if you buy, we come back to the example before, we said we had 100 notional and 97 you bought it. So first you book it for 97. If the market drops below the 97, you go even below that. And you stay always below 97. A minimum value is even more extreme. So if the value drops from 97 to 95, you write it down to 95. And whatever the value goes up, you never write up. We will see that in a little bit more detail in the next lecture. We touched already on the concept of parallel valuation. This must be possible. And the interesting thing you will see is that on the event level, there's only one set of events. So the events, they are independent of bookkeeping. Events give you the reality of the financial contract. And from the same set of events, you derive different values. So valuation means interpreting the events differently. But there are rules. So in finance, it's not totally arbitrary. There are rules how to do it, and there's a certain set of accepted rules how to do it. So because we have the same set of events, we have full consistency between the different valuation methods. Before we come closer to the concept of valuation, yet the notion of a chart of account. This is also related to the fact that in RiskPro, the first thing you have to define is a chart of account before you even can define a contract. Now that's really a specialty of RiskPro, and actually even a bad one. So the contracts should be actually fully independent of any chart of account. So a financial contract can live whether there is a chart of account or not. The financial contract needs only itself plus the market or the risk factor conditions. Given that, you can derive any event and the valuation method, and then you value whatever you want. But the chart of account still has a lot of good features, and it's good to have one. So it's not that bad that you have to define one when using the software, because it represents a product catalog. So it's like basically what kind of products does the bank sell? So first you have cash, that's one product, of course, but then the other one is interbank. So a bank deals, buys and sells with banks. And then there are all type of loans. So you have consumer loans, you have mortgages, you have this type, that type of industry loans, etc., etc. So these are all different types of products the banks is selling, and on the liability side maybe buying. So, and in this sense, it has quite a good it's quite helpful. So the role of the chart of account is different whether we are in static or in dynamic analysis. In static analysis, yes, we could even live without it. We could group it, but always it's good to group it in chart of accounts, because bankers anyway, they have the chart in account of account or the balance sheet they have in their mind. So it's something comparable already there. And if they see the numbers organized along the chart of account, that's already very helpful, because things are familiar. You don't have to explain too much. So even in static analysis, the chart of account is helpful. In dynamic analysis, the chart of account is a must. We will see that when we come to dynamic analysis So it's even a logical necessity to have something which is or corresponds to a chart of account. Often valuation methods are closely linked to chart of accounts. So, for example, if you have a mortgage book and you use amortized cost method, you use it for the entire mortgage book. You don't have some mortgages valued like that and other mortgages valued at that, especially if they are in the same category of the chart of account. In the same account. So you would never have two valuation methods within one account of the chart of account. So that's important. But you might have different valuation methods in different accounts. So the chart of account is also very closely linked to the way you value your assets and your liabilities. We mentioned before about 8-9 bookkeeping methods. Which are out there, market-related, non-market related, only time-related. Of these 8-9 which are out there, actually 4 have been sanctified by the IFRS, the International Financial Reporting Standard, so which defines what is acceptable or not acceptable as a bookkeeping method in finance. And the 4 which have survived of all them are nominal value, historical value, amortized cost, and market value. And the market value, you could call it the primus inter pares, so it's equal or first among equals. And I call them the big 4. We will have a very close look at these 4. We will also look at the others, which I still think have some survival possibilities, but these 4 are really the very important methods. What comes now is what I would call mathematical bookkeeping or scientific bookkeeping. So please follow step by step, and that will give you the relationship between financial events and bookkeeping and the different bookkeeping methods, which is a highly confusing matter because it's normally not presented in a good way. So I hope we do a little bit the better job here, and especially with the background of the contract types, it should become very clear how the different bookkeeping methods relate to each other. So here we have the notion of beta. Beta is now an index to denote the bookkeeping rule. So beta could mean mark to market or nominal value. So beta, let's say the first beta, the value given mark to market at point T. So that's how you have to read this. The first formula I even want to write a little bit simpler, just that you see really what it denotes. I say value equal nominal value plus PD. I just left away the indices to have to see it a bit clearer. So if you have a value and any valuation method, the first part of it is the nominal value, and the second part is the premium discount. So now we continue and look at what that means. The first question is, so what is nominal value? So here. So the nominal value, you see there is no beta there. That means the nominal value is fully independent of the bookkeeping method. So the nominal value at any point T is the sum of all the cash flow, and we have here L, that means the principal cash flow. So interest cash flow or other cash flows are not counted in it, but it's the principal cash flows of TI, and TI is bigger than T. So it means if you are here at T, 0, so all the cash flows from the future just summed up. So whatever you get as cash in here, the sum of that then makes the total nominal value at this point. So past is here not important here. So that means the nominal value is just all the principal cash flows which are still outstanding summed up to today. So that is for nominal value, important. And now we come to a next concept. So this has all been on value, on V, and we see there, and we still have then to explain what that means. So that is coming. But before we go there, we talk now about income. And we say income again at beta. So depending on the bookkeeping beta, is the change of value at time t, given time progressed here, and given you have beta as a bookkeeping method, plus accruals are here. No? So it's the change of value of plus accruals. And let's look at this then in more detail, how you write it. So that's still, and this is the momentary, that's the momentary accrual. No? But real income, you have between 2 points of time. So the income of beta between ti and ti plus 1, so one time step further. So it's the nominal income between the two, and that corresponds to this part here. To this part here. And then the change of value, which corresponds to this part here. So again, nominal income here, which corresponds to nominal value, is not depending on bookkeeping rules, but the change of the premium discount is depending on the bookkeeping rules here. And the nominal income, so this part here, is the nominal value. So the meaning the nominal value is what we said up here, the outstanding future principal cash flows, times the rate, which is applying then, let's say the interest rate, times the time difference, so for how long the rate applies. And then there is this change in the premium discount. We will understand it better in the next few slides. So the difference of the bookkeeping methods, beta, are only concerned with the calculation of either PD or delta PD. If I go back here, so we saw here the beta only applied here to the PD, and the beta here in the income only applied to delta PD. That's the only difference. So we have to understand PD and delta PD to understand bookkeeping rules. And the big part, the nominal income, that's the same for all bookkeeping rules. Coming back to that little example which I mentioned already before, let's say we bought that for 97 and the notional is 100 here. So I pay 97 for the bond here. I will get back 100 somewhere in the future. So we have two certain points. Now we assume there is no credit default risk. Let's assume it's a Swiss government bond. So paying 97 here, getting back 100 here. So that means the only difference between the bookkeeping rules is how I go from this point to this point. And I showed already 3 very simple things. So one, I go straight down here, this method, and then write it up here. That is what we call the historical method. The other one was to write it off here and then go straight in this direction. That was the notional, and that linear line is linear right off. But what we want to say here, that only the trajectory of PD changes as a function of the bookkeeping rule. So what we must do is we calculate PD as a function of the bookkeeping rule, and we store that in parallel and add it to the notional part. So, and then we have all the different bookkeeping rules in parallel. We start with nominal value. So nominal value, and this is a little bit more complex contract type. It's what we would call an RGM, and you have one in the book. But it's one with what we call incremental payments. Incremental, that means you pay out first a part and then you pay another part. So it's paid out in 2 installments. Let's assume you have a house. You get half of the money here. You get the other half of the money here. And then you have to pay back here in 3 installments over these times here. So now let's look at the nominal value here in this case. So what would be the nominal value at this point in time? We said it's the future principal cash flow. So if that is an outflow, let's say this is a negative, then depending how I look at, but from a bank's viewpoint, this is a negative. I pay, then I receive this one, I receive this one, and I receive this one, and of course the nominal is then, if you look at on the net basis, so it's exactly, this is the nominal value. You can see also in this case, this nominal, the notional, is also the same like this cash flow. So we could not only say it's all the future cash flow, the sum of the future cash flow, it's also the sum of all the past cash flows. That is possible in this case. But this is a special case because here, what we have here is premium discount equals 0. So in this case, it's easy to see. Otherwise, it's more difficult to see. So it doesn't hold in all cases here. But in this case, it does hold. So we see the nominal value, how it changes. So here the nominal value is so much. So in this case, it's so much. After this, it's so much, etc., etc. So nominal value is changing all the time, and it's 0 after this. Now, okay, so we have now nominal value evolution over time. And now what would be the income here? So E. Now we talk about E here. Now it's the nominal value times the rate, we said. So the rate is just on this, and on the time it's linearly calculated. So that is the income over time. And at this time, we assume there is a payment. So this is then a cash payment. That's the interest payment here. And then the accruals goes down to 0. So and in this section, maybe the same rate applies, but we have now double the nominal value, so it accrues double speed. And here it's getting less and less. If the rate would have changed, again, let's say we would have a higher rate here, then of course, even it would have been like that. So that is the income, how we have to calculate it. And we said then, generally said value is equal nominal value plus PD, and income is equal nominal income plus delta PD. Okay, so we have now understood nominal value, nominal income, where is PD and delta PD. In this case, this is equal 0, and because PD is equal 0, then also delta PD is equal 0. So that's exactly what happens in nominal value. You don't care about any premium discount. You assume it's always 0. So that says what the nominal value is made of. So the nominal value is a very special case where delta premium discount is 0, on premium discount is 0, and after the break, we look now at all the rules where PD and delta PD is not 0. Thank you for listening.